at 145 shillings. The situation is expected to worsen if proper measures are not put in place. This is according to the managing partner at the AMG Capital, George Munga. As Ian Keitani now reports, this comes at a time when the cost of living continues to skyrocket.
As the country battles the high cost of living, the situation is expected to worsen as the Kenyan shilling continues to deteriorate against the dollar, which now trades at 145, despite different figures being fronted by the Central Bank of Kenya. According to the managing partner at AMG Capital, George Munga, the weakening of the shilling has been brought about by several factors, top among them increased pressure and over-dependence on importation.
There has been supply chain disruptions all the way from COVID times. You remember when COVID struck, there was disruptions in the world trade and supply chain. And when COVID eventually subsided, there was a lot of pressure for traders to try and catch up. Meaning there was an increased pressure for importation for most of the economies around the world. The economy has not been very stable. That goes even before the 2022 elections. Already there was a lot of pressure on our debt repayment. Remember, in November last year, the government was not able to meet its dollar obligations for loan repayment. They had to defer, I think, around $699 million repayment that was due. That were due then.
Just what will be the effect of the weakening shilling on the economy?
Today we were importing petrol, say at $60 a barrel, and tomorrow we do at $80 a barrel. Then that essentially go into your pump price, meaning the cost of petrol will increase by a similar margin. That is why you've seen the cost of fuel increase from, I think, from all the way from November on a month-on-month basis. And of course, when the price of energy increases, the price of energy, let me put it that way, increases, then it affects the common mwananchi almost immediately. The cost of raw materials that we import to be able to manufacture our day-to-day goods that we consume increases.
This comes as the Treasury Principal Secretary Chris Kipto insists that there is enough dollar in the country despite the low circulation.
If things were to remain the way they are, then the shilling is likely to slide even lower. I was telling you that our forecast is that the shilling might go to 150, 160 if nothing was done between now and June.
If the government does not find proper interventions in place, what will be the situation of the shilling?
Remember, we closed the year when the dollar was around 116, 117, and within 3 months we are trading at around 142 today. I think some banks are quoting 142 today, and we forecast as people who play in that space that the dollar might go all the way to 150 or 160 by June this year. That is if the government doesn't intervene.
Even as the government plans to import oil from Saudi Arabia using the Kenyan shilling, Munga insists that it is a strategic move and it will help in stabilizing the situation.
If we are able to get a country, an oil-producing country that can sell us oil, and they accept payments and other means other than the USD, then of course we'll ease pressure on the demand for USD. According
to Munga, one of the ways to ensure that the situation gets better is through floating for another Eurobond, although it might not be a long-term solution.
If they go out there and secure maybe another Eurobond, the only challenge I would have is at what rate will they get those finances to be coming into the economy. What that does is that it is able now to cushion the Kenya shillings from the day-to-day fluctuations.
Ian Keitani, Look Up TV.
Thank you, Ian Keitani, for that detailed report.